Hi everyone, welcome to another episode of Peaceful Investing. Today we'll be talking about active versus passive investing. Since we covered Nifty Strategy Indices, which are the means to do passive investment, there was this query that we should look into active versus passive investing comparison. So here I am with that. Before we start, there's a disclaimer. This video is just for informational and education purposes. This is not in any way any investment advice or recommendation. So please do your own research before doing any investments. All right, so let's proceed. Uh, this snapshot is as of today. The This is from Value Research Online. The link for this is over here. So on each and every tab of this Excel, you will find the source from where this information has been obtained. So if you take up this link and put in your browser, you will get the same data. What I've done is I have sorted this as per returns based on last 10 years, 3rd July 2015 to 4th July 2025. And this data is for all the equity funds, uh, direct plan, all the active equity funds, no passive funds over here in the snapshot. Uh, and Be it open-ended, closed-ended, all the equity mutual funds and direct plans of theirs. So as expense ratio is low and returns are higher. So this captures the data of 232 equity funds, and we see that the highest return is across the 10-year period is around 23%, and then there are only six mutual funds which have given more than 20% return in the last decade. All right. So what I want to highlight over here is, if you look at the column H, uh, I want you to have a look at the start date, launch date of these mutual funds. So uh, they are across 2006, 2008, 2013, 2014, and 2015. If I look at, if I see which mutual funds have been they here who have been launched, which have been launched in 2006 to 2008, all I get is these two mutual funds. Both are from Quantum AMC, and the returns are around 13% in this last 10-year period. That's it. That's it. One of them was 2006 and one of them was from 2008. Apart from that, all the mutual funds here are either from 2013, 14, or 15, which is very surprising. Mutual fund industry is very old in India. I don't know why this is happening, but there must be a reason to it. But what I would like to highlight over here is these returns and these mutual funds, they have not lived through the most volatile event of this century, which is global financial crisis, and 2008, that is. So these returns, uh, these performances, they don't capture the most volatile period, which was experienced in 2008 because of global financial crisis. All right. And these returns are only for last 10 years. Hmm? So what I'll do over here is I'll get all list of all the mutual funds which have greater than or equal to 18% returns in the last 10 years. So based on that filter, I get around 30 mutual funds from which have given returns from 18 to 23%, in the range of 5% across last 10 years. Hmm? All right. So let's look at and all of them have been launched in 2013, 14, or 15. Let's look at which equity category they belong to. So if we look at, there are no pure large cap funds in these. One mutual fund is there, which is from large and mid cap segment. There are seven mutual funds from the mid cap segment, and there are eight mutual funds from the small cap segment. So this all in all is dominated, these top performers, all in all, they're dominated by small cap and mid cap. Okay, then we have ELSs, two ELSs, two flexi cap, and two multi cap. So five broad market funds, we can say. And then the rest of the nine are sectoral funds. Uh, four from infra, one from three from IT, one PSU fund, and one energy fund. Sectoral indices, they are like thematic indices. I am not so keen on them because they're not all season. So they perform during one period and they don't perform during the other period. So they are very volatile and the returns are very difficult to come by. So, and very skewed and lopsided the returns are. But they're very volatile as well. All right. Moving on, if we compare them with the passive indices, which we discussed in our last video, I've added this link of this Excel as well as link of this video, in which we have discussed the Nifty Strategy Indices top performers, in the description, so you can have a look over there. Over here, we can see the returns are again the top performers 18 to 24%, 21, 22, 23, 24. 18, 19, 23, 20, 23, 18. All right. And we see four all cap funds over here, four all cap investment strategies, two small cap investment strategies, two large and mid cap investment strategies, two mid cap investment strategies, and one mid and small cap investment strategy. And many funds could be there on these strategies. All right. And mind you, these CAGRs or these rolling returns, which is 10-year rolling returns, which you see, they are for 20-year period, more than 20-year period. All right. These volatility, these maximum drawdowns, this sharp ratio, these Roma numbers, they are for 20 years period, more than 20 years period, which covers global financial crisis as well. So the track record is they have sustained for the last 20 years or so. So for apples to apples comparison, we need to see, we actually need to know the drawdowns, the volatility, and the returns in last 20 years for these mutual funds. But they haven't been existing for last 20 years, so we cannot comment on that. But the returns are pretty much comparable, right? So the highest returns are 23% over here, 22% in passive funds. All right. The returns are pretty much comparable, though this is for just for 10 years and that is for 20 years. And so we can, and the fund categories also are the similar ones. All right. They also don't have any pure large cap fund over there in the passive strategy. And over here also, we don't see in the top performers any large cap fund, pure large cap fund. All right. Now let's look at this snapshot is from SPIVA report card, which is published by S&P every year. So this is as of 31st December 2024. What they're trying to showcase over here is that in terms of active funds, how many of them across 1, 3, 5, and 10-year period underperformed S&P passive funds? Okay, the picture doesn't look very good over here. So if you look at the large cap across 5 and 10 years period, long term, let's look at the long term picture, right? So across 5 and 10-year period, 93%, 93% and 74% of the actual active mutual funds have underperformed the S&P passive benchmark. When it comes to ELSS fund, it is 72% and 84%. A huge number. I would have expected the figure to get better with the longer tenure. So, but for 10 year, it is 84% of the active mutual funds have underperformed. And in mid cap and small cap segment, again, it is 77% for 5 years. And for 10-year period, it is again 88%. All right, rest of them are for bonds. I'm not going to discuss the fixed income funds. I would be, let's talk about the, no, let's, no, I'm not getting into debt segment. Let's discuss the equity segment only. So, again, the source of that this report is here in this Excel. So as you can see, it is very difficult for an investor like you and me to pinpoint which funds are actually going to be uh, beyond these 80, 90%, 90%, 70% bracket, which are going to be the benchmark beaters, which are going to beat the benchmark during the next 5 or 10 years. The probability is very less that you will pick the winners or the top performers because the percentage is not 50-50. It is skewed towards the losing side, the ones who are not able to beat the benchmark. All right. Now let's look at how the passive funds have picked up in the last decade or so in Indian market. So if we look at the this data comes from the NSE report, and the original source is AMFI. If we look at the percentage of assets under management under passive funds of the total AUM in the market, that has increased from 2% in 2000 FY financial year 2012 to 17% in FY 24. So that's a stupendous increase. All right. So people are adopting passive mutual funds more and more. Let's see how this picture is outside India, especially in developed markets. Let's look at the picture of this from US. So if we look at the last 10 years fund flows in the active and passive mutual funds, apart from 2014 and 2021, the net inflows into active funds has been on the negative side all across. And total net inflows are altogether net inflows are negative in the active funds. But on the passive funds, every year it is positive, and aggregate also it is positive. Okay, and much higher, much higher. Even in the years in which the active funds received positive inflows, the passive inflows were the inflows into the passive funds were much higher. And in 2024, for the first time, total assets under management in US passive funds has surpassed the total assets under management in the active funds. That's something to think about. So I believe going forward, it seems we will also move in this direction. There's reason to it, right? Uh, Fund managers, so a strategy, it is consistent. Of course, there will be long periods of underperformance as well. All right. But the track record which you witnessed was only for 10 to 12 years. And I'm sure these funds would have existed earlier also in some other avatar, in some other form, and would have done, and they are now rebranded and reshaped. All right. We cannot comment on how they would have performed, but for sure their performance would have been affected on the lower side because of the global financial crisis. If we have taken the period, that period also into account, which strategy funds have taken into account when we are comparing their performance. Second thing, the mutual fund managers, the strategy remains consistent across 20 years. It doesn't change across decade to decade. It stays consistent. There is no human bias. It is totally devoid of emotions. All right. But mutual fund managers, apart from few mutual funds like Parag Parikh, where Mr. Tucker is managing the fund for right from the beginning, last 12 years or so, or more than that. For rest of the mutual funds, the portfolio manager, mutual fund manager, changes quite frequently. So how can you rest assured that the ones mutual fund which has been topping the charts in terms of returns earlier won't continue to do the same in the future? Okay. Then let's look at these numbers from the AMFI, these statements from the AMFI report. The source is again here in the Excel. Passive funds are making inroads much faster. They have grown at a CAGR of 44% from 2019 to 2024. And HNI, high net worth individuals, are the earlier adopters in this category, in passive funds category, because their AUM has grown 56 times between March 2019 to March 2024. So that's something to think about, huh? So on that note, I would also like to specify, it doesn't mean that passive active funds don't work at all. They do, they must be working. They do work, probably. And that probably is evident in this count over here. If you see that the most of the top performers in the active fund categories are from small and mid cap category. I believe the reason for that is that since small cap stocks and few of the mid cap stocks, they are covered less, they get less analyst coverage. The information regarding them flows inefficiently through the market, and a fund manager maybe would be aware of something special or would have observed through his own research something particular about that company which is not there in the public domain. So, if the markets are little inefficient or uh, there is alpha in active funds for such categories, small cap and to an extent mid cap is that category. It's pretty much like real estate, right? A local dealer would probably know much more about the local real estate market because the information flow is less efficient. There are no exchanges on which real estate prices are displayed or traded every day, or there is any bid ask spread which people can see. All right. So it's the information is not easily available to everybody. It is through inefficient channels it is spread. So there is alpha over there. All right. On that note, I leave you. Thank you very much for your time.